Picture this, it is a Tuesday afternoon, you are waiting at a red light, and your phone suddenly buzzes with a notification from your insurance company. Your 6-month policy is up for renewal, and your premium is going up by 12%. You stare at the new number, trying to figure out what changed. You have not had an accident in 8 years. You have not had a speeding ticket in more than 10 years. You drive a practical sedan, not some flashy sports car. You take the same route to work every day. You are probably the safest driver you know, the kind of person everybody jokes is boring because you actually go the speed limit and use your turn signal every single time. So you call your insurance company and ask why your rate increased, and the customer service rep gives you a vague answer about risk, market conditions, and actuarial tables. When you push for details, they say it is based on your profile. Your profile. You are a perfect driver. So what profile could possibly justify a 12% hike? What you do not know is that your coworker, who actually rear-ended someone last year, just got his renewal and his rate only went up 3%. Same insurance company, same city, same coverage, but he caused an actual accident and he is paying less than you. The only difference? He lives in a different zip code, went to college, and has a better credit score, even though none of those things have anything to do with how safely he drives. My name is Alicia, and I spend way too much time exposing the supposedly objective systems that squeeze money out of people who can least afford it, while pretending it is all based on data and fairness. If you have ever looked at your insurance bill and felt like something was off, or if you have been told insurance rates are purely about risk, while your perfect driving record says otherwise, hit subscribe and give this video a thumbs up, because what I am about to show you will completely change how you think about car insurance. Most people assume car insurance rates are based on how well you drive. That sounds logical, right? Insurance is supposed to cover accident risk, so safer drivers should pay less and riskier drivers should pay more. That is the deal we think we signed up for. You drive carefully, avoid accidents, follow the law, and get rewarded with lower rates. But that is not how it actually works, and the insurance industry has spent millions making sure you do not understand the real formula behind what you pay. Let me introduce you to Marcus. He is 38 years old, works as a delivery driver, and has been behind the wheel for 20 years without a single accident. None, 0 speeding tickets, 0 fender benders, 0 insurance claims of any kind. His driving record is so clean it is basically invisible. He drives a 2015 Toyota Camry with 120,000 miles on it, nothing fancy, and he has stayed with the same insurance company for 6 years because he heard loyalty gets you better rates. Last month, Marcus got his renewal notice and saw his premium jump from $140 a month to $173. That is a 23% increase in 1 year, $33 more each month, or $396 more per year for a driver who has never cost his insurance company a single dollar in claims. Marcus called to ask why, and the representative said his rate was adjusted based on updated risk modeling. When he asked what risk they were modeling if he had never had an accident, they said it was based on multiple factors, including his credit score, his zip code, and his job. His credit score, his zip code, his profession. None of those things have anything to do with how safely he drives, but all of them are perfectly legal for insurers to use when setting rates. And that is where the scam becomes obvious, because these factors are not random. They are systematically built to charge more to people who are already being squeezed by every other part of the financial system. Think about what Marcus just learned. The company looked at where he lives, what he does for work, and what his credit report says, and decided that makes him a greater risk than somebody who actually caused a crash. That should make no sense at all, but it makes perfect sense once you realize insurance companies are not really pricing based on driving risk. They are pricing based on what they can get away with charging you. Let me show you the numbers that prove this is not about safety. A 2022 Consumer Reports study analyzed 2.3 billion car insurance quotes across every major insurer, and found that drivers with excellent credit pay an average of 68% less than drivers with poor credit, even after controlling for driving record. 68%. Same car, same coverage, same accident history. But if your credit score is below 650, You are paying almost 70% more than someone with a score above 750. Now explain how a credit score predicts whether somebody will run a red light. Explain how paying your credit card bill late makes you more likely to cause an accident. It does not, and the insurance companies know it does not. But they use credit scores anyway because the correlation they care about is not with accidents. It is with price sensitivity. People with lower credit scores usually have fewer options, less room to shop around, and less ability to pay 6 months up front to get the discount, which means insurers can charge them more without losing them. The same study found that zip code had an even bigger effect on rates than driving record. A driver with a perfect record living in a predominantly Black or Latino neighborhood can pay more than a driver with a DUI living in a predominantly white suburb. Let that sink in. You can have no accidents, no tickets, the safest car on the market, and still pay more than someone who drove drunk if you live on the wrong side of town. Marcus lives in a zip code that is 72% Black, with a median household income of $43,000, and his insurance is 59% higher than the price for identical coverage in a zip code just 15 minutes away that is 81% white with a median household income of $78,000. Same city, same company, same coverage. But because Marcus lives where he can afford to live, he pays 59% more. Over 10 years, that is thousands of dollars taken from him simply because of where he lives. Occupation is the third piece of the puzzle, and it is just as arbitrary as the others. Insurance companies set different rates based on what you do for work, supposedly because some professions correlate with different risk levels. That sounds reasonable until you look at what is really happening. A Consumer Federation of America study found that insurers charge professionals like doctors and lawyers much less than they charge service workers like delivery drivers and warehouse employees, even after controlling for income and driving record. Marcus is a delivery driver, which means he spends more time on the road than most people, and you might think that justifies a higher rate because more driving means more exposure to risk. But his coworker James is a software engineer who drives the same distance each day and works from home 2 days a week. So he actually drives less than Marcus, yet James pays 41% less for insurance. Same number of miles driven per year, same clean driving record, but James has a job that is coded as lower risk because he wears a button-down shirt to work instead of a uniform. When you put all the pieces together, you can see how the system works. Marcus has a credit score of 635 because medical debt went to collections 3 years ago. He lives in a zip code that insurance companies have labeled high risk based on claims data that may or may not actually reflect his personal risk. He works as a delivery driver, which insurers treat as a higher risk profession, even though he has never had an accident. None of those factors predict whether Marcus will cause a crash, but all of them predict that Marcus can be charged more without switching companies. Think about what that means in actual dollars over his lifetime, because the compounding effect is enormous. Marcus is paying $173 a month for car insurance. His coworker James, with the exact same driving record but better credit, a whiter zip code, and a white-collar job, is paying $98 a month with a different company. That is $75 more every month for the same coverage. Over a year, that is $900. Over 10 years, that is $9,000, and that assumes the gap does not widen as insurers keep changing their algorithms. That is $9,000 Marcus could have invested, used to improve his credit score, or saved for a down payment on a house in a neighborhood where insurance would be cheaper. Instead, it goes to an insurance company as profit because they know they can charge him more and he probably will not leave, since switching is annoying, and the other companies will likely quote him similar rates using the same discriminatory factors. And it gets worse, because we have not even talked about the way insurance companies use discounts to make you feel like you are getting a deal when you are really just paying less of a penalty. Insurers advertise good driver discounts, safe driver discounts, accident-free discounts, and they make it sound like you are being rewarded for being responsible. Marcus gets a 15% good driver discount, which sounds nice until you realize the base rate they are discounting is already inflated by all the other factors we just discussed. What is actually happening is that insurers set a baseline that is higher than it needs to be, then hand out discounts to make you feel lucky. The good driver discount is not a reward for safe driving. It is just removing part of a penalty that should never have been there in the first place. Marcus gets 15% off a rate that is already 59% higher than it should be because of where he lives, so he is still paying far more than someone in a different zip code who drives worse than he does. There is also the loyal customer penalty, which is one of the most frustrating parts of all this. Insurance companies know most people do not shop around every year because it is time-consuming and annoying, so they lure new customers in with low introductory rates and then slowly raise those rates every year, betting that you will not notice or will not bother switching. A 2021 National Bureau of Economic Research study found that customers who stay with the same auto insurer for more than 6 years pay an average of 23% more than they would if they switched to a competitor. 23%. Marcus has stayed with his company for 6 years because he thought loyalty would be rewarded, but he is actually being punished for it. He is paying $173 a month when he could probably find the same coverage for $133 if he spent an afternoon getting quotes from 5 different companies. That is $40 a month, $480 a year, gone because he trusted that staying put was the smart move. The historical background makes this even more infuriating, because using zip codes and credit scores to set insurance rates is not some brand new data science breakthrough. It is a way of continuing redlining without saying race out loud. From the 1930s through the 1960s, insurance companies could legally refuse to sell policies to Black people or charge them more explicitly because of race. When that became illegal in 1968, the industry found new ways to produce the same result using supposedly race-neutral factors that just happened to create the same racial gaps. Zip code is the clearest example. Neighborhoods in America are still segregated largely because of redlining and discriminatory housing policy. So when insurers charge more for certain zip codes, they are effectively charging more based on the racial makeup of that neighborhood. They can claim it is about claims data and risk modeling. But when the higher rate zip codes are disproportionately Black and Latino neighborhoods, even after controlling for actual accident rates, at some point you have to admit what is going on. Credit scores work the same way. Black and Latino families have lower average credit scores than white families because of the racial wealth gap, which exists because of housing discrimination, employment discrimination, and every other form of systemic racism that has limited wealth accumulation for generations. So when insurance companies use credit scores to set rates, they are punishing people for being victims of discrimination while pretending it is just objective risk assessment. Let me tell you what happened to the real Marcus, the person I know who figured out he was being scammed. He spent an entire Saturday afternoon getting quotes from 12 different insurance companies, which is more work than most people would ever do. But he was angry enough to put in the effort. What he found was genuinely shocking. Quotes for the exact same coverage ranged from $118 a month to $247 a month. Same car, same driver, same coverage limits, but depending on which company he chose, his annual cost could be anywhere from $1,416 to $2,964. That is a $1,548 difference per year based purely on which company he picked, and none of it had anything to do with how safely he drives. The cheapest company was one he had never heard of, and when he called to confirm the quote, they asked about his education level. He told them he had a high school diploma and some community college, and the rate immediately jumped by 18%. He asked why, and they said education level is a rating factor in their state. He asked what education has to do with safe driving, and the representative gave him the same vague answer about risk modeling and actuarial tables. Marcus eventually found a company that would give him the same coverage for $128 a month, which was $45 less than he had been paying. That is $540 a year he had been overpaying. $540 that had been extracted as a poverty tax because his previous insurer knew they could get away with it. But finding that better rate took him 6 hours of comparing quotes, reading policy documents, and calling customer service lines, and that time has value too. 2 years later, Marcus is still with that cheaper company, and his rate has crept up to $149 a month, even though he still has a perfect driving record. The loyal customer penalty is already kicking in again, which means he will need to shop around soon if he wants to avoid getting gouged. This is the exhausting reality of being a perfect driver in a system built to extract the maximum amount of money from you. You have to constantly fight just to avoid being overcharged for something the law requires you to have. Think about the twisted incentives this creates, because insurers make more money when they can split customers into groups and charge different prices for the same product based on things that have nothing to do with real risk. They spend millions lobbying to keep credit scores, zip codes, and education levels legal as rating factors, because those are the factors that let them charge more to the people least able to push back. At the same time, they spend millions on advertising to convince you that insurance is all about safe driving and accident history, when those factors are actually less important than where you live and what is on your credit report. The most maddening part is how this system hides behind the language of data and objectivity. Insurance companies will tell you their actuarial models show that people with lower credit scores are more likely to file claims, and they will point to correlations in the data. But correlation is not causation, and even if some correlation exists, that does not mean it is fair or appropriate to use credit scores as a pricing factor. What the data really shows is that people with lower credit scores are more likely to file claims because they cannot afford to pay for minor repairs out of pocket, so they use insurance for things wealthier people would just handle themselves. The credit score is not predicting worse driving, it is predicting financial vulnerability. Insurers are using that vulnerability to justify charging more, which makes the financial situation worse, which causes more claims, which then justifies higher rates, creating a vicious cycle that keeps people trapped. So calculate what you are actually paying versus what you could be paying, because the difference may shock you. Go to at least 5 insurance company websites right now and get quotes with identical coverage. Use your real information and see how much the rates vary. If you find something much cheaper, switch immediately. There is no reward for loyalty in this business, only penalties. Challenge the factors if you can. Some states have already banned or limited the use of credit scores in insurance pricing. California, Hawaii, and Massachusetts do not allow it, and other states are considering similar laws. If you live in a state where credit-based insurance scoring is legal, contact your state insurance commissioner and your state legislators and demand that they ban the practice. There is no good reason your credit history should affect your car insurance rates, and the only reason it is still legal is because insurers have more lobbyists than you do. Improve your credit score if you can, not because it is fair that they use it, but because that is the reality you are living in. Pay down high-balance credit cards, dispute errors on your credit report, and set up automatic payments so you never miss a due date. Every point your credit score rises can potentially save you hundreds of dollars a year on insurance, which is ridiculous but true. Consider moving if the insurance savings justify it, though I know that is not realistic for most people. But if you are already planning to move and comparing neighborhoods, include insurance costs in the decision. A place with rent that is $50 a month cheaper might actually cost more overall if insurance is $75 a month higher. The total cost of living in a neighborhood includes the insurance penalty you pay for living there. Bundle your policies if it actually saves you money, but do not assume it always does. Sometimes separate policies from different companies are cheaper than bundling everything with one company. The insurance industry wants you to believe bundling is always better, but that is just marketing. Do the math every time. Shop around at least once a year, ideally before renewal. Set a calendar reminder, block off an afternoon, and get quotes from at least 5 companies. The loyal customer penalty is real, and the only way to avoid it is to constantly threaten to leave. It is exhausting, and it should not be necessary, but that is the system we are living in. Join organizations fighting for insurance reform. Groups like the Consumer Federation of America, the Center for Economic Justice, and united policyholders are pushing for regulations that would ban discriminatory pricing factors and force more transparency in how rates are set. The more people who support those efforts, the more pressure there is on lawmakers to actually do something. The insurance scam exists because we have allowed companies to use factors like credit scores and zip codes that have nothing to do with driving safety, but everything to do with extracting maximum profit from vulnerable people. Marcus pays more even though he is a perfect driver, because the system is not built to reward safe driving. It is built to identify who can be charged more without walking away. Every perfect driver paying inflated rates because of their credit score, neighborhood, or education level is being robbed slowly, one renewal at a time. And that robbery is legal because the insurance industry has convinced regulators that discriminatory pricing is just sophisticated risk assessment. Your insurance rates have almost nothing to do with how safely you drive, and almost everything to do with how well insurers can slice you into a demographic they can overcharge. That is not a flaw in the system. That is the business model. The question is whether you are going to keep paying the poverty tax or whether you are going to fight back by shopping around, demanding reform, and refusing to accept any of this as normal or fair.